Good afternoon, ladies and gentlemen. It's a great pleasure to be with you this afternoon for the Switzer Group's Investor Strategy Day. I'd like to thank the Switzer Group for putting on such a wonderful afternoon. I've thoroughly enjoyed the other presenters and what they've had to offer. I've certainly learned a lot. It's nice to have met so many of the investors here today, and along with some of our existing investors too. So we're here today to discuss why an alternative investment should be part of your investment strategy. When most people think about investing, traditional methods such as stocks and bonds usually come to mind. These have been the main options available to everyday investors. While diversification is possible within these different types of investments, their overall performance can be strongly linked to the global economies, meaning that they may tend to rise and fall in tandem. This has led investors looking for alternative investments and results that are not correlated to the existing markets. They want portfolio diversity and to protect themselves from traditional market fluctuations. These can be classified as alternative investments. Alternative investments applies to a broad range of vehicles, including real estate, hedge funds, managed funds, private equity, venture capital, precious metals, fine art, wines, coins, collectibles, oils, and financial derivatives. There are quite a few. Traditionally, some of these have only been accessible to high net worth individuals or institutions, requiring high entry payments or the investor to be accredited with a particular net worth. However, as investors' appetite for alternative investment methods have grown, particularly following the 2008 financial crisis, alternative avenues have begun to open up, with various retail managed funds pooling investor money to gain entry to these markets, along with peer-to-peer lending. Peer-to-peer lenders have provided additional investment options. Years ago, the financial services offered to people to gain a return on their principal investment amount was very cut and dry. Shares, real estate, or fixed-term interest. Now investors have the opportunity to invest in other avenues and other vehicles to gain a return on these newer funds. Part of this disruption to financial services is due to the growing popularity of peer-to-peer lending. This lending process is a method of debt financing that allows individuals to borrow and lend money without the use of an official financial institution as the go-between. It's lending made simple, without the mountains of paperwork and the hoops to jump through. Now the banking community are taking notice of these new emerging players in the market and the lending sphere, as peer-to-peer lending makes its move towards larger loan offerings than solely offering small dollar amount personal loans. Customer bases are decreasing from the major financiers, making this disruption evident. As more borrowers start to outsource their loans from the major financiers, the efficient lending and investing terms through peer-to-peers may emerge as a considered option. However, the lending options available to investors or coming out of the woodwork are not just limited to peer-to-peer lenders. There's financial technology and fintechs. There's a new breed of alternative investments available now to investors. These startups have easy and ready-to-use options for investors looking for alternative returns. Never in a million years would you have thought that Woolworths would compete with the banks. But even the lending sphere has succumbed to your former friendly everyday grocer is now offering credit cards, personal loans and insurance options. Alternative investments, they come with their own set of unique risks and advantages. Their main benefit is that they offer or can offer a low correlation to existing stocks and bonds, meaning that they tend to perform best when the world markets may be struggling. As part of a balanced investment portfolio, they can increase long-term returns, especially during repeated periods of financial uncertainty. Gold, for example, has had a low correlation with stocks and bonds during the past 40 years. Alternative investments may also result in a lower transaction cost, as they tend to be turned over less frequently. On the flip side, some alternatives may be less liquid than traditional stocks and bonds, which means that there is a limited market in which to sell them. The values of commodities like oil, crops and grapes can be volatile, and also they can be vulnerable to such aspects as global supply or natural disasters. It can be difficult to gauge the likely performance of or current values of such rare items as coins, stamps and diamonds, because there's a limited history of previous trading. During times of strength in the global economy, alternatives are often outperformed by stocks and bonds. For these reasons, it's essential that you do your homework before considering alternative investments. Ideally, you want to focus on the greatest level of negative correlation to your existing portfolio. Also, factor in your investment timeframes. Are you looking for short-term or long-term returns? Assess your tolerance for risk and bear that in mind when you're considering more volatile investment vehicles. If you're looking to invest, ensure that you investigate the performance of the investment itself. Also make sure that you're fully aware of any fees and charges that may apply. There are an ever-growing range of alternative investments available to investors, and their use within your existing portfolio can provide you with both a healthy long-term return and a measure of protection against the bear market. It gives me great pleasure to introduce Investors Central. This is an investment, an alternative investment opportunity. This is an investment where the investors rank in preference to be paid. The investor ranks before ordinary shareholders, and there's a covenant to mandate this through a prospectus. There are no other finance creditors other than the investors, and the investors receive a monthly interest payment. The company has been profitable from day one and has never missed a monthly interest payment to its investors. From inception, 100% of the profits have been reinvested back into the company, and there's a covenant to mandate this into the future. Ladies and gentlemen, Investors Central is an Australian-owned, unlisted public company. Investors Central raises capital to invest through the wholly owned subsidiary of Finance One. Established in 2010, Finance One continues to provide more Australians the opportunity to purchase a motor vehicle, ultimately providing freedom through transport and an improved lifestyle. Finance One specialises in secured vehicle loans and has a current loan book of over $80 million, with over 6,500 active clients with a current loan, the average loan size being $16,700. We have established our business on a national level through a network of over 1,000 finance brokers. The company is led by a driven team of executives who have consistently delivered increased profits and strong returns to our investors. All the directors of the business have their own capital invested into the business. Our investors, they gain an understanding into our business model, which is quite different to most other investment companies. So I would like to take the time today to highlight some of the fundamentals of how we do business and why we're so successful. We work with what we know. Finance is our specialty. Finance One and Investors Central have now been in business since 2010 for over 7 years. However, I've been lending and collecting money, operating in the finance industry since 1997 for over 21 years. 1997 was not the ideal time to start lending money. Unemployment was over 8%, in some pockets of Australia, well over 10%. But we were not only lending the money, but we were collecting the loans that we financed ourselves as well. So you certainly learn to build your credit matrix when you've got to go out there 3 nights a week to collect the debts. Not only that, is that we were lending through, I was lending through the GFC of 2008, where we actually grew, because we had finance to be able to lend out. A lot of the competitors pulled away from that industry sector because they didn't have the finance to be able to lend out. So our customer base grew, and we managed our clients through that repayment process. Steady, profitable growth in our target market has continued to deliver our expanding investor group outstanding returns on their investment. Backed by a diverse loan portfolio, our investors are attracted to our fixed terms, ranging from 1 to 5 years, at fixed interest rates of between 8 and 14.35% per annum. An investment in Investors Central is free from any fees and charges to you, which sets us apart from many similar investments. Sounds too good to be true. I certainly hear that from time to time from new investors looking at our business and our current investors who are kind enough to refer other investors to our company also do hear that from time to time. We have to go back to where we started. Our first investor was an interest rate of 18% is what they were earning when we had a $358,000 loan book. And we've grown over that period of time. We started raising capital with our foundation group of investors through an information memorandum at interest rates to them of between 14 and 18%. We then became an Australian unlisted public company and raised capital through a prospectus. We're on our 4th prospectus now on our current rates. One of the main reasons why we pay an equity-style return through a fixed interest rate is because we wanted to retain 100% ownership of the company, which we've been able to do. So we reward the investors for that. Not only that, is from time to time we get asked, well, why don't you go and get bank funding? Or why don't you go and get a large financier to fund your book at a cheaper rate? We could do that. We're in a position now where we could do that, but we won't subordinate our existing investors. Not only that, is that we've moved past competitors because those larger financiers from time to time change their credit decisions and move out of certain industry sectors. Or you go through a GFC and a lot of those financiers move past that. Well, we've got diversification through our investors. No finance debt other than our investors. We raise capital through a prospectus over a rolling 12 months. Investors are issued redeemable preference shares. Computershare is our share registry, and they do issue share certificates in the company and do the monthly distributions of interest back to the investors. Redeemable preference share investors rank first. They rank before ordinary shareholders in preference to be paid. Redeemable preference share investors, there is a covenant in place to say that we won't take on any financial debt, secured or unsecured, while any redeemable preference share investor is outstanding. So they rank first, apart from customary trade and statutory creditors. Subsequently, we have delivered 7 years of positive returns to our investors, totaling over $24 million. We also keep 7.5% of funds borrowed set aside in cash for capital adequacy and or early redemptions. Early redemptions, though, are at the total board's discretion, keeping in mind the board focus on the integrity of the business as well as the protection of the overall group of investors. We borrow long and lend short. So what does that mean? Our average investor term is 49 months. Our average term for Finance One client is 41 months. So we're very prudent in regards to that. Finance One has very strict lending policies. While our assessment process is personalised, when assessing an application, we take the time to ask more questions than the average lender so we can fully understand our client's personal financial situation and credit history. We are a high document lender. We get a lot of information that others don't. Our finance brokers supply us with an application form, proof of address and income, a credit file, a minimum of 3 months' worth of bank statements for a consumer loan or up to 6 months for a commercial loan, along with a proposed vehicle purchase. The finance broker network is only a referrer of a lead to Finance One. We do all the decisioning internally. What we do, though, looking for that client, is we validate their job. So we ring up the employer, making sure their employment is ongoing, their year-to-date figure is right. We check their ABN number. We then do the same with their address. If they're paying a place off, we may get a mortgage statement, but if they're renting, we always get a tenant's ledger, making sure they're making their rent payments on time. We also ask a series of profiling questions around that client. Are they keeping their principal place of residence in a neat and tidy condition? If they can't maintain the home, they're not going to maintain a motor vehicle. We then drill down into their credit purchase, but also 3 months' worth of bank statements. It's a window to somebody's financial soul. You're able to see what their discretionary spend is, and do they really have capacity to repay that loan. Consequently, on average, historically, even up until today, only 1 in 5 clients are settled with a loan with Finance One. 4 out of 5 don't make it through. We are very prudent on whom we choose to give a loan to. Another unique attribute about our business is our focus on managing client relationships throughout the term of their loan. I've been collecting money for 21 years. Our team work closely with each client to help them through the repayment process and to keep them on top of managing their obligations. We see this as an integral part of our responsibility to clients who have specifically come to us to either establish or re-establish their credit rating. Like any lender, there are times when people can experience difficulties for whatever reason. We have the processes in place for these occasions to recoup the funds like any responsible financier. It's how we work with and engage our clients that is ultimately how we keep them on track. The opportunity and success of our automotive credit products has paved the way for Investor Central to offer a high-yielding return to our investors. Finance One. We have developed a comprehensive national finance broking network. In fact, we've grown our broking network from just 140 in 2013 to now over 1,000 motor vehicle finance brokers across Australia promoting our range of products. We have representation in every state and territory. They refer loans to Finance One, who follow strict lending guidelines, credit analysis processes, and due diligence tests to ensure that we're taking on good quality clients. Our lending policies, they promote responsible lending, and our personalised loan management procedures mitigate the risks associated with borrowers' defaults. Finance One's major point of difference in the market has been its compassionate and personal approach to lending, allowing us to help hundreds of new clients every month. We are an excellent alternative for vehicle finance when other avenues may have been exhausted. It's a simple business model, one which is totally transparent to our investors. We provide finance to clients who genuinely have the capacity to repay, but we choose the direct investor model rather than the large financial institutions. This provides us more autonomy and to compete in market segments where others cannot. I mentioned before we've been profitable from day one. The next slide, which is in part of your handout, shows our earned income growth over the last, since 2012, moving forward. But some of those highlights is our revenue's grown from $10.4 million in 2015 to $15.5, and we're on track for revenue of over $20 million this year. Net profit, $2.1 million in 2015. Net profit before tax, $2.75 million in 2016, and we're on track for more than $3.3 million this year. And our total equity has grown also from $3.9 million of 15 to 5.8 of 16, and we're on track for over $8.1 million of equity this year. 100% of the profits since inception have been reinvested back into the loan book to build equity and a stronger company, and there's a covenant mandating this into the future as well through the prospectus. Our loan book value also increased 20% from June 2016 at $59 million to over $71 million. And just for our half-year report that we've caught up with our investors, we paid them $4.7 million for our half-year report. This next slide we're particularly proud of. It shows the gap, and the gap continues to grow between the size of the loan book and funds borrowed from investors through the reinvestment of profits every month. Like any lender, risk management is a vital part of our business, and we manage this very carefully. As Finance One's loan book grows and matures and remains competitive in this industry sector, we're budgeting on medium write-off levels of between 11 and 14% of our revenue. For our 6-monthly half-year report, our write-off of revenue for bad and doubtful debts was 9.7%. Managing risk has always been a priority for Finance One, and our loan account managers continue to stay in regular contact with our clients. We've increased our provision for doubtful debts to now over $2.4 million. This is a prudent and cautious view of managing the loan book. Our next slide looks at our write-off tolerance. This helps demonstrate the strengths of the business model. The following graph shows our loan book principal and interest owed to Finance One over the next 5 years, which is over $105 million. As at the 31st of December of 2016, we owed to our investors after cash holdings are returned to them $59 million. That's a difference of over $45 million from what we're owed by our clients to what we owed our investors. If we took our historical write-off tolerance of 2.3% into account, it still leaves us with a balance of $103 million. If we try to stress test the business model and take a 7% write-off, we'd still be left with more than $98 million. Or to extrapolate that write-off to 25%, we're still owed more than $79 million. The write-off tolerance equation is designed to help understand the strengths of the business model. We continue to build a substantial margin of safety. Investor Central has taken a measured approach to growth and raised capital to match the opportunities presented by our expanding business and broker networks for Finance One. We are proud to provide complete transparency, demonstrating to investors exactly how money is used to generate these strong returns. Finance One currently lends on average approximately $4 million per month, but we have the infrastructure in place to lend over $6 million per month. It's this gap that represents the opportunity for our existing investors to expand their portfolio with us and for new investors to enjoy the returns that we offer. The marketplace demand for our product is strong. Our historical performance in this industry sector is robust. Our company, we understand the responsibility we have to our investors. At Investor Central, we try to take a tangible bricks and mortar approach in providing the tools for our investors to fully understand the business that they're investing in. We have a transparent, open book policy to provide the data for the investors to fully understand the business that they are investing in. Our investor initiatives include a detailed performance report which is put out every 3 months to our investor base. It details the performance of the loan book along with our profit and loss for our financials. As we're an unlisted public company, we then do our fully audited report on a yearly basis and our half-year reports where we catch up and have lunches in most capital cities for our investor base. With easy access to our board of directors and management team. Through these key initiatives, it's essential to provide the investors with the understanding of knowing exactly how their money is being used to generate these profits. This approach sees the majority of new investors coming from referrals, with over 90% of our existing investors rolling over into additional terms. We are fortunate to have the staff who value the role they play in improving the financial well-being of Australians, and it's through their strong commitment that they have built Finance One and Investor Central into the enterprising companies they are today. So that's an alternative investment idea for you. Thank you for your time today. I look forward to meeting some of you this afternoon. All the best.